Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts as they share with you the insider's guide to property investing.
Okay folks, you're with us on the Property Couch, your insider's guide to property investing. It's Bryce, Holdaway and Ben Kingsley talking to you today. How are you, Ben?
G'day, Bryce. Very well, thank you.
That's good. Today we're going to talk about a continuation of a series that we're doing on this podcast called the Property Investment Formula, and more specifically, the 4 pillars that you need to master to be a good property investor, whether you're a first-time investor or whether you're someone who's been investing for many, many years with multiple properties. These 4 pillars discriminate against no one.
They limit the mistakes, crew. So that's exactly what we are here to talk about.
Now, Ben, you're suitably qualified to have this conversation today because I've been a buyer's agent property investment advisor for over 15 years, but you started out in this industry. You were recently awarded the Property Investment Advisor of the Year, but that started from the beginnings of you being a mortgage broker.
Yeah, that's right. So avid investor from the age of 23. So I've been, sort of investing in property since I was almost just over 20 years now, 44 this year. And yeah, to get into property investment, one of the big things you need to understand is getting access to cash and using other people's money, as sometimes the industry refers to it. So borrowings, leverage, those types of things. So that's really what we're talking about here today. And that is the B in the mastery. So
borrowing power.
Borrowing power. So we're trying to understand how that all works. So that's what we're going to have a bit of a conversation about today.
Now, Ben, we're going to talk about asset selection next week, which is the bricks and mortar, the bit that everyone wants to start with. But there is a pretty strong case to suggest that borrowing power is what property investing is all about. Because if you get borrowing power wrong, no matter how good your real estate is, you can hit glass ceilings, can't you?
Good point. And the other message there is also, if you are thinking you're going to save your way to building out a property investment portfolio, you're kidding yourself. You'll buy 2 properties over a 40-year period. So yes, you're absolutely right. So what we want to talk about today, the relationship. Last week we talked about cash flow management, but today borrowing power is all about taking your surplus cash and seeing how much money you can actually borrow to acquire the property. And by acquiring it, we're leveraging it. So we're looking and focusing on getting a cash-on-cash return, which means that our smaller amounts of money is working harder because it's controlling a bigger asset. So an example would be if I have $100,000 to invest, and whether it be equity in my current home or savings that I've got, I release that out and I might say acquire a $500,000 property. Well, I'm getting returns on the $500,000, so I'm getting my rental income, my yield, and my capital growth on that bigger value. So as long as I can look after servicing the debt, I'm in a good stead to actually accumulate the wealth quicker. So if I can't do that, hence the cash flow management story last week, then I'm going to be in all sorts of strife. So let's get into the importance of borrowing power, Bryce. I mean, for you, what do you see as borrowing power and its importance?
Look, I think if you get, I think this is marginally less important than getting the asset right, because I've seen a number of times. I'll talk about a story about 4 or 5 years ago now, where a client came to me and they had a significant property portfolio with, on paper, the ability to borrow more money because their LVR was quite low, but they actually had all of their lending with one bank. It was National Australia Bank, which is in principle nothing wrong with the bank.
Fine bank.
But having a couple of $1 million worth of lending with that particular bank meant that the bank felt exposed and their risk profile was too much of a concern for them to let them borrow any more money, despite the fact that on paper they could afford it. So I think when someone talks to us about lending, if they talk to us about interest rates and establishment fees, we're not interested. We talk about structure and the amount of interest that you can save over the life of the portfolio. And for us, it's about getting standalone lending versus cross-collateralised lending.
Yep, that's right. And coming back to that point you were making there around, saving $300 a year on interest, as opposed to having say a 5% gain on a $300,000 property, which is a $15,000 gain. It's just that we don't turn up into our driveway and the $15,000 sitting on the front porch. It's the material gain that we're seeing in the asset. And I want to take it a step further and talk about the relationship between borrowing power and prices. So, because that links into income. So you've heard, if you've ever listened to me rabbit on about things, what I talk about is the property prices are set by income. Now, what I mean by that is the amount that I can borrow. So let me give you an example. Let's say there's a young couple who are going to, these days they go and see their mortgage broker. 25 years ago, they went and saw their bank manager. And they go in and they've got a rough idea. They're not silly these days. Most people are doing, a bit of research on the internet, and they're getting an idea of what their borrowing power is. They've at least used one or two of the calculators online. But they've sort of come and said in their mind, okay, their mindset is, we can borrow up to, say, $400,000, and we've got some savings there as well. So let's say we want to buy for $450,000. That's their estimation in terms of before they go and see their broker. They sit down with their broker, and their broker's got 25, 30 lenders available to talk to. He crunches their numbers in terms of the income and their expenses and their living costs, and says, well, based on what I can see here, lender A is going to lend you $400,000, lender B is going to lend you $430,000, lender C is going to lend you, $500,000. So all of a sudden, it changes the dynamic about what's going to happen. So they're sitting back saying, the broker's saying, well, look, we can get a pre-approval for up to $500,000. Oh no, we only wanted to purchase for $450,000. So they're sitting back going, okay, well, that's fine. You go off and research that. They go home, they get on the internet, and they put in their searches in domain and realestate.com, and they come up with the properties that they think are worth $450,000. But we can't trust real estate agents, or selling agents for that matter. So what's actually happened is that all the properties that are listed in there are worth $500, probably more.
No, in terms of, do they? Surely.
No, yes, they don't quite allow them what you go. So what actually happens then is they go out and have a look at these properties on the weekend, and all of a sudden they're conditioning themselves to a higher value point. And now we as investors are got to understand the owner-occupier, because remember, they control 70% of the marketplace. They actually ultimately set the price. So the investors might stimulate the market in a short period of time, but the price will find its value where the owner-occupiers see value in all the big cities. Different story for mining towns, but that's a conversation for another day. So they come in and then ultimately they convince themselves that that's the asset, because when they go and see what their $450,000 can buy them, they almost, are definitely going to look at that $500,000 property, whether it be a little bit newer or whatever it may be. So for me, borrowing power is the science of, from an investor's point of view, is grabbing other people's money and controlling that money, but seeing exactly what people can afford in that particular marketplace, because we're trying to study the growth rates of that particular area.
Yep. I guess the important point there is that a lot of people see supply and demand as being a product of population growth. But for the listeners there, what you're saying is, and I 100% agree, is that an investment grade suburb is largely determined by the profile of the people that are living in that suburb and whether or not they're likely to get a pay rise or not next year. Because if you buy in a suburb where people are on similar income, similar amount of credit cards, similar amount of debt, similar amount of kids, whether or not they buy a suburb that's 400 and they just using 10% growth, it's going to be worth 440 next year. It's not enough for them to desire that they want to pay that much, because they're going to go to the bank under this sort of pillar of borrowing power and say, how much can I borrow? And the bank's going to say, you can still only, on your income, you can only still borrow 400,000. So whether or not they want to pay for whether or not they want to pay 440 or not is irrelevant. Yeah. It's totally a product of their income. And that's the gold for the listeners, isn't it?
It is. You can move 20,000 people to a new location, but if their combined household income has a ceiling of borrowing power of $400,000, doesn't matter how much the desire is for the people who are potentially trying to build stock worth 500 or 550,000, or the desire of the buyer to actually go in and buy that property, just not there. So that's where obviously areas that are new estates on the fringes of cities are the most affordable, because they've got people who are going there who have low incomes, who are just starting out in their careers or whatever, and so that's where the affordability lives. In the bigger cities, all around the world, you can't get into units or houses or villas or townhouses unless you pay a premium, because that attracts the premium of lifestyle and convenience, and people will pay a premium for that. But as long as their incomes support that conversation.
Now, you and I have chatted about this many, many times, but for the benefit of the listeners, let's talk about in the past, there's been a case for the rising tide lifts all ships.
Yep.
Now, you and I have the view that that's not going to happen moving forward. But it's not just a theory. We've got something to back it up here.
Yeah, we do. So let's talk about that. So when we finished the Second World War, we had a lot of our obviously returned soldiers coming back to Australia, and we're a young nation. And as a young nation, we basically came back proud of what we've achieved, and we had this boom period. So the 50s and 60s were actually living quite well. Our standard of living was excellent. We had, Holden factory building cars. We were, we had jobs, and we started to believe in the dream of owning our own home. Now, prior to that, in the Depression in the early 1900s, there was only about 30% of the population who actually owned, and the rest, obviously rented. So we went through this fantastic phase, and that was where the concept of the Great Australia Dream really took off. And it was easy because the roads were, non-congested. The cities were ghost towns at the time because everyone was going out to their suburban houses. And what we saw through that period was the first signs of income and borrowing power being directly correlated to the value of the property. Then we went through the 70s, and the 70s we had a real different change. What we saw happening was mums got a part-time job for the first time, so a little bit more income coming into the disposable household. And again, I'm a 71 baby. What we actually saw there was the girls that I went to school with were actually looking at careers for the first time. So fast track to the 90s, and they're now, finishing university and off getting their six-figure salaries. And so we've got this now double household income story, and we've got low interest rates. So when you get low interest rates from a borrowing power point of view, you get the ability to borrow more. So that's been the rising tide story. So we've had these sort of critical events. The other critical event, I should say, was in the 90s. We were quite insular. We had tariffs. We were unproductive. We were inefficient as a nation. The recession that we had to have, we decoupled the Reserve Bank from the federal government, and monetary policy was set independently. We had inflation running between 10 and 12%. We had, for those of you who have been around long enough, we had interest rates 17, 18%. It was tough. But we got through that period. We've become more efficient and more streamlined. Our infrastructure was better, and we've got through that. Now we've got these low interest rates as a means, as a lever to pull on to see that. So when interest rates get low, borrowing power increases. So that's the rising tide lifting all ships that we're seeing across all the markets. But in other times when we actually don't have that rising tide lifting all ships, we know that the suburbs that have desirability and people's ability to borrow because they've got good incomes, they grow in value. And that's what we look for in terms of the asset selection, which is obviously a conversation for next week, but it comes back to that borrowing power story.
Well, that's evidenced in suburbs. If you think about the median for Melbourne being around 600,000, and yet you go to Middle Park or Albert Park and they're, $1 million medians. Same in Sydney, the median's a bit higher, but you go to Mossman or, some of their double bays. So the question is, are they unaffordable, or are they just a product of income? And I think it's, pretty obvious that the wealthy people in each city live in those suburbs, therefore they can afford to pay higher prices, and therefore that's what drives it up. I remember chatting to a friend of mine who was on the Gold Coast, and he was asking for some advice on what should I invest. He's got twin girls, and he wants to invest some money for them when they're 7 years of age, when they turn 18. And he said to me, look, I think I should invest on the Gold Coast because of the games coming in 2018. And I think that's actually a common thing that you hear people say, isn't it? Because I think that we have given, here we are on podcast number 4, we've given our best gold for any property investor. We're talking about giving the insider's guide to property investing. Right there, what you just talked about for people is it takes away the mystery of what it is that you're looking for. It's about income. It's not about the Gold Coast having the games coming up, because sure, that might provide a short-term peak in demand, spike, and a bit of interest, but long-term longevity. There's a reason why being close to capital city job markets has outperformed, and that's because of incomes. And I think that's a really important thing to talk about. Now, I wanted to talk about one of the other points that you brought up before too, and that's the borrowing power is really a story of leverage, as you mentioned. But we're not going to get into a comparison of what's the best asset class. But I always think that leverage ultimately determines it's kind of like the independent umpire of which asset class you should go into. So say you bought some shares that were doing say 12 or 13%, and you only bought some real estate that was doing 8%, at face value you'd think, well, the shares is a better asset.
Yeah.
But if you can leverage into more real estate, and that 8% return gives you a better dollar return than the 12% on your shares, to me that's the independent umpire, because I'm pro shares, I'm pro business, I'm pro property. I'm certainly got a very strong bias towards residential property, and clearly that's our passion.
Absolutely.
But I always think that under this pillar of mastery in terms of borrowing power, I think leverage can be the independent umpire to any argument that anyone has as to what's the best asset class. Because the shares guy's going to love it, the property guy's going to love it, and you can talk about it all day.
And that is, I mean, I don't have a love affair so much to beautiful property. I mean, I enjoy lovely property, but it's a vehicle for wealth creation. And so that was the light bulb moment for me, Bryce, back probably when I was about 25, where I sat down and understood cash on cash returns and saw what leverage did.
Do you want to explain that just a bit more, cash on cash return?
Yeah, so cash on cash return basically means that if I put my $100,000 in and I control an asset worth $500,000, then I'm getting an accelerated return. Sure, I have to pay debt, so I might have a $400,000 debt, but I'm actually getting an accelerated cash on cash return. So obviously at that point I said, well, I understand what leverage does, and I can leverage into the stock market. I can do CFDs, which are contracts for difference, which is another conversation again. But what I found was volatility. And so when I found residential property, it's an essential need. It's shelter. So, people aren't going to be living in caves. So all of a sudden I thought, wow, if I could get into property, but next week we're going to talk about not just any property, because you can lose money. This is not just a lay down misere, go off and get into heaps of debt. Please don't do that. There's people losing money in property investing, and there's probably quite a bit of that happening in Sydney at the moment. So what's important to understand is it is about sensible gearing. So why did we talk last week about cash flow management? That's about making sure you don't overextend yourself. You don't set the house of cards up to fall down by doing that. So it really is a story about borrowing. Now, isn't it interesting? We haven't talked in this session anything about, how they work it out, assessment rates and all that, because all you need to understand is what's sensible in terms of what you can afford, and then what price point then you should be going searching, and then finding the asset that complements that. So if you've got really strong surpluses, you're going to chase growth assets, and if you've got short surpluses, you're going to chase a little bit more yield in terms of that conversation. But we haven't made this conversation about, as I said, assessment rates, offset accounts, borrowing structures. There is a lot more that we can talk about that, and we've got plenty of time in these podcasts another time.
We'll do that on another day. Now, look, we're running out of time. We've got a couple of minutes to finish. I mean, this is what happens to us. The time just flies all the time. But what I did want to talk about is just quickly on closing. With borrowing power, you've really got two major options. You can go to a mortgage broker, or you can go to the bank. And I think for the listeners, just to declare the fact we are a mortgage broker as part of our day job, so there is a little bit of bias there. But I think there's a strong case to suggest that if you've got an investment savvy mortgage broker on your team, and you're interested in mastering this pillar, which is borrowing power, you're going to give yourself the best chance. Because if you go back to my story that I talked about at the beginning of the podcast, where I had a client who had been quite successful with property, but they had all their lending with NAB, and then NAB said to them, you now don't fit our risk profile to lend you any more money. That wouldn't have happened if they had an investment savvy mortgage broker on their team. So the point being is a mortgage broker thinks of finance like a game of chess. They're trying to think 2 or 3 loans in advance, or in a game of chess, obviously 2 or 3 moves in advance. And whilst it is always a comforting feeling to have a relationship manager with a particular bank and have all your lending, and because it's a hard thing to master, it's always safe to feel like you've got that one person. We have a really strong view that an investment savvy mortgage broker will serve you better.
Look, ultimately the customers decide. Why has mortgage broking gone from 0% in the 90s to now 50% of all lending? It's got to tell you a story, doesn't it? I mean, just the fact that they've got choice and that the broker is going to be working for the actual borrower. The vehicle of where they get their funds from is from a suite of lenders, but at the end of the day, they're working in the best interest of the client and giving choice. That's a huge value proposition. And then the smarter brokers who understand investment strategy and structure, well, once you find them, don't let them go.
So the question for the listeners is, if they're going back to their bank or they're going back to their mortgage broker, they need to find out if they're giving them advice or just facilitating a transaction.
Correct.
And the ones that are just facilitating a transaction aren't going to serve them. Well, here we are, 20 minutes. We said we don't want to go over 20 minutes each week. So there's so many things that we could talk about under this pillar of mastery, which is borrowing power, but obviously time's run out and we'll talk about them in another podcast. So next week we are going to be talking about asset selection, and that's really where most people start, but we've actually made it later in our series for a purpose. And last week you talked about, or in the first week of our podcast, you talked about investor stock versus investment grade stock. So we're going to talk about that next week.
Brilliant.
But for those of you, if you wouldn't mind going to the iTunes store or the podcast store and leaving us a review or a 5-star rating, that'd be great. You can also follow us on Facebook, Instagram and Twitter under the Property Couch. And of course, if you've got a question that's just burning on your mind that you want Ben and I to cover in one of these podcasts, you can go to thepropertycouch.com.au and leave us a little note about the topic that you'd like to talk about, and we will talk about that in a future podcast. Ben, it's been fun.
As always.
As I said, next week we're going to be talking about asset selection, so I believe we've got a sign off.
We have a sign off, I think. Arrivederci.
See you folks. See you next week.